I am about to tell you something that I rarely discuss publicly, where I am actually putting money to work right now, not where I've been invested for decades, not what is already in the portfolio, but the sectors where I see the greatest opportunity over the next few years and where I am actively moving capital before 2020. Now, I know what you are thinking. Doesn't this contradict everything you've said about not timing the market, about buying great businesses and holding them forever, about ignoring macroeconomic predictions? And you'd be right to ask that question, because normally I don't make sectoral bets. I don't try to predict which parts of the economy will outperform. I just look for wonderful businesses at reasonable prices and let compound interest do the work. But every few decades, something changes. The landscape shifts in ways that create obvious opportunities for those willing to see them. Opportunities so clear, so compelling, so mathematically favorable that ignoring them would be foolish. And right now, in late 2025, I am seeing three such opportunities. Three sectors where the risk-reward is so skewed in the investor's favor that I am actively repositioning capital to take advantage. Let me start with a story that explains why I occasionally make these sectoral shifts, despite my general philosophy of buying and holding forever. Back in the early 2000s, I looked at the American energy landscape and saw something that most investors were missing. Natural gas was becoming increasingly important to the American economy. Power plants were switching from coal to gas. Industrial users were expanding gas consumption, but the infrastructure to move gas from where it was produced to where it was needed was woefully inadequate. I started building positions in pipeline companies and energy infrastructure, not because I was predicting oil prices or making bets on commodities, but because I could see that physical infrastructure would be needed regardless of short-term price fluctuations. Someone had to move the molecules from point A to point B, and the companies that owned that infrastructure would collect tolls for decades. Those investments worked out extraordinarily well, not because I timed the market perfectly, but because I identified a structural need that wasn't going away and invested in businesses positioned to meet that need. The same logic applies to what I am seeing today. Three sectors with structural tailwinds so powerful that the businesses serving them are likely to prosper regardless of what happens in the broader economy. The first sector I am moving into aggressively before 2020 is insurance, specifically property and casualty insurance and reinsurance. Now, you might think this is strange coming from someone who already owns one of the largest insurance operations in the world. But what is happening in the insurance industry right now is unlike anything I've seen in my 60 years of involvement in this business. Let me explain what has changed. For decades, the insurance industry operated in a relatively stable environment. Yes, there were hurricanes and earthquakes and other catastrophes, but the frequency and severity of these events fell within historical ranges that actuaries could model and price for. Insurance companies could predict their losses with reasonable accuracy and price their policies accordingly. That world is gone. Climate change has fundamentally altered the risk landscape for property insurance. Hurricanes are more frequent and more severe. Wildfires in California have become annual catastrophes, costing tens of billions of dollars. Flooding from atmospheric rivers and storm surges is affecting areas that never flooded before. The historical data that actuaries relied on for a century is no longer predictive of future losses. This might sound like a reason to avoid insurance companies, not invest in them, and for weak insurance companies with inadequate reserves and poor risk management. That is exactly right. Many insurance companies will fail over the next decade because they underprice risk and can't pay their claims. We're already seeing insurers flee entire states like California and Florida because they can't make the math work. But here's what most people miss for strong insurance companies with disciplined underwriting. This chaos is an enormous opportunity. When weaker competitors flee markets, the remaining insurers can charge higher premiums. When catastrophe losses exceed expectations, premium rates rise across the entire industry. When capital leaves the insurance business, returns on the capital that remains improve dramatically. We're in the early innings of a massive repricing of property insurance risk. Premiums that were stable for years are now increasing by double digits. Annually, policies that were barely profitable are becoming highly profitable. Insurance companies with strong balance sheets and disciplined underwriting are seeing their earnings explode, and the repricing isn't done, not even close. The insurance industry is still catching up to the new reality of climate risk. Every year brings new catastrophes that exceed historical models. Every year, the gap between what insurers are charging and what they should be charging narrows, but we're years away from equilibrium, which means years of above. Average profitability for the survivors. I am looking for insurance companies with several specific characteristics. First, they need fortress balance sheets with excess capital to absorb unexpected losses. Second, they need disciplined underwriting cultures that will walk away from business rather than write policies at inadequate prices. Third, they need geographic and risk diversification so that no single catastrophe can threaten their solvency. Fourth, they need management teams with track records of navigating hard markets successfully. The reinsurance market is particularly attractive right now. Reinsurers are the insurance companies for insurance companies. They take on the catastrophic risk that primary insurers can't handle. And right now, reinsurance prices are at levels we haven't seen in decades. The returns available to well-run reinsurers are extraordinary. I am also interested in specialty insurance lines that benefit from the current environment. Excess and surplus lines insurers that write coverage for risks that standard insurers won't touch. These companies can charge premium prices because there is nowhere else for customers to go. When mainstream insurers flee difficult markets, specialty insurers thrive. The opportunity in insurance will last for years. Climate risk isn't going away. If anything, it is accelerating. The repricing of property insurance is a multi-year process that is just beginning. And the investors who recognize this early and position accordingly will benefit enormously. The second sector I am moving into before 2027 is energy infrastructure, specifically natural gas pipelines, liquefied natural gas terminals, and electrical grid infrastructure. This is where I see perhaps the most obvious opportunity in today's market, an opportunity hiding in plain sight that most investors are completely ignoring. Here is what is happening. The world is experiencing an explosion in electricity demand, unlike anything we've seen in decades for the past 20 years. Electricity consumption in developed countries was essentially flat. Efficiency gains offset economic growth, but that has changed dramatically and permanently. Artificial intelligence is the primary driver. Training large language models and running AI inference requires enormous amounts of electricity. A single data center supporting AI workloads can consume as much electricity as a small city, and we're building these data centers at an unprecedented pace. Microsoft, Google, Amazon, Meta, and dozens of other companies are racing to build AI infrastructure. Each new data center requires reliable electricity supply. The numbers are staggering. Data center electricity consumption in the United States is projected to more than double by 2030. Some estimates suggest it could triple or quadruple. This isn't speculative growth dependent on AI technology working out. The data centers are already being built. The electricity demand is already being contracted. This is happening right now, but here is the problem. Our electrical grid wasn't built for this. The transmission lines, the substations, the generation capacity, none of it was designed to handle this explosion in demand. We're facing a potential electricity shortage in parts of the country, not because we can't generate power, but because we can't move it to where it is needed. This creates an enormous opportunity for companies that own electrical grid infrastructure, transmission line operators. Transformer manufacturers, utility companies in regions with data center demand These businesses are suddenly facing decades of growth that was unimaginable just a few years ago. Natural gas is central to this story. Despite all the talk about renewable energy, natural gas is the only realistic way to provide reliable baseload power for data centers in the near term. Solar and wind are intermittent. They don't generate power when the sun isn't shining or the wind isn't blowing. But data centers need electricity 24 hours a day, 7 days a week, with essentially perfect reliability. Natural gas turbines can provide that reliability. This means natural gas demand is going to increase significantly over the next decade, even as the long-term transition to renewables continues. The pipelines that move natural gas from production basins to power plants are going to be more valuable, not less. The companies that own these pipelines will see higher utilization and potentially higher tolls. LNG, liquefied natural gas, is another major opportunity. Europe desperately needs natural gas after cutting off Russian supplies. Asian countries are building out gas infrastructure to reduce coal consumption. American LNG exports are growing rapidly and will continue growing for years. The terminals that liquefy gas for export and the pipelines that feed those terminals are positioned for substantial growth. I am looking at this sector with fresh eyes because the investment thesis has fundamentally changed. 3 years ago, energy infrastructure was viewed as a declining industry. Investors assumed that renewable energy would make fossil fuel infrastructure obsolete. Valuations were depressed. Dividend yields were high. Now we're realizing that the energy transition is going to take much longer than expected, and that gas infrastructure will be essential throughout that transition. Meanwhile, AI is creating new demand that nobody anticipated. The companies that own critical energy infrastructure are worth far more than their stock prices suggest. The opportunity here is both growth and value. Growth because electricity demand and gas demand are increasing faster than anyone expected. Value because the stocks still trade at valuations that reflect the old narrative of declining demand. As the market recognizes the new reality, these stocks should re-rate significantly higher. The third sector I am moving into before 2027 is healthcare, specific companies serving the aging baby boomer population. This is the most predictable opportunity I've ever seen in my investing career, and predictability is worth a lot when you are deploying capital. Here are the demographics. About 76 million baby boomers were born in America between 1946 and 1964. They're now between 61 and 79 years old. Over the next decade, this massive generation will move into their 70s and 80s, the years when healthcare consumption increases dramatically. There is nothing speculative about this. The people have already been born. The aging process cannot be stopped. The increase in healthcare demand is mathematically certain. The only question is which companies will benefit most. Healthcare spending increases dramatically with age. The average 65-year-old consumes about 3 times as much health care as the average 40-year-old. The average 80-year-old consumes about 5 times as much as the baby boomers age. Total healthcare spending will increase substantially regardless of what happens with healthcare policy or the economy. I am focusing on specific subsectors within healthcare that have the most direct exposure to aging demographics. Medical devices is one area of particular interest. Hip and knee replacements, heart valves, pacemakers, hearing aids. These are products consumed primarily by older patients. The companies that manufacture these devices have virtually guaranteed demand growth for the next 20 years. The economics of medical device companies are often excellent. High margins, recurring revenue from disposable components, strong competitive moats from regulatory barriers and surgeon training, limited price sensitivity, because insurance or Medicare typically pays. These are exactly the kind of businesses I love to own. Senior housing is another subsector with compelling demographics. The oldest baby boomers are just now reaching the age when assisted living and nursing care become necessary. We're in the very early stages of a massive wave of demand for senior housing that will last for 2 decades. and the supply of senior housing is constrained by zoning restrictions, capital requirements, and operating complexity. The senior housing stocks were crushed during COVID, when mortality in nursing homes devastated occupancy and finances. Many of those stocks still haven't recovered to their pre-COVID levels, but the fundamental demand thesis is stronger than ever. The demographic wave is coming regardless of what happened during the pandemic. Healthcare services companies focused on managing care for seniors are another opportunity. Medicare Advantage plans, home health providers, hospice operators, these businesses benefit directly from the increasing number of seniors in the healthcare system. Many of them have strong competitive positions and predictable revenue streams. Pharmaceutical companies with drug portfolios focused on conditions that affect older patients are also attractive. Cardiovascular disease, cancer, diabetes, Alzheimer's disease, osteoporosis. These conditions are more prevalent in older populations, and the patient population is growing by millions every year. One aspect of the healthcare opportunity that I find particularly compelling is the combination of demographic certainty and current undervaluation. Healthcare stocks were among the worst performers during the recent market cycles. Investors worried about drug pricing pressure, regulatory risk, and margin compression. Many healthcare stocks trade at valuations well below their historical averages. This creates a favorable setup. We have near certain demand growth from demographics combined with depressed valuations from recent underperformance. Even if the companies just grow in line with the demographic tailwind, the stocks could appreciate significantly from valuation normalization alone if the companies execute well and grow faster than demographics alone would suggest. The returns could be exceptional. Now, let me address why I am emphasizing the 2027 timeframe. Why not just say these are good long-term investments, which they are, because I believe the next 2 years represent a particularly favorable window for establishing positions in these sectors. In insurance, we're in the steepest part of the repricing cycle. Premiums are rising fastest right now as the industry catches up to climate reality. The companies that benefit most from repricing will show dramatically improved earnings over the next 2 years. Waiting means paying higher prices for stocks that have already re-rated. In energy infrastructure, the AI electricity demand is accelerating in 2025 and 2026 data centers that were announced in 2023 and 2024 are coming online now. The increase in electricity consumption will become impossible to ignore. The stocks will re-rate as investors recognize the changed demand picture in healthcare. The oldest baby boomers are hitting 79 and 80 years old, the age when healthcare consumption really accelerates. The demographic wave is just beginning to crest. The next 2 years will demonstrate the reality of aging, driven demand growth in ways that investors can't ignore. All three sectors also benefit from the current interest rate environment. Insurance companies earn investment income on their float. Higher interest rates mean higher investment income. Energy infrastructure companies often have debt in their capital structures, but the strongest companies have locked in low rates and benefit from higher rates. Reducing competition, healthcare companies are generally less interest rate sensitive but benefit from the overall economic stability that moderate rates provide. Let me also discuss how I think about position sizing across these three sectors. I am not making equal bets. The risk-reward profile differs for each opportunity, and my allocations reflect that. Insurance is my largest allocation because I understand the business deeply after 60 years and because the repricing opportunity is so clear. This is a sector where I can evaluate management quality, underwriting discipline, and reserve adequacy with confidence. The downside is limited because even if catastrophe losses are worse than expected, the repricing cycle will continue and eventually create value. The upside is substantial if losses normalize and premium rates stay elevated. Energy infrastructure is my second largest allocation. The opportunity is clear. but the timing is less certain. Regulatory changes could slow infrastructure development. Natural gas prices could be volatile. The AI electricity demand, while certain in direction, is uncertain in magnitude and timing. I want meaningful exposure, but with position sizes that acknowledge these uncertainties. Healthcare is my third allocation, not because the opportunity is less compelling, but because the timing is more extended. The demographic wave will play out over 20 years, not 2. There is less urgency to establish full positions immediately. I am building positions gradually and expect to add over time as opportunities appear. I want to emphasize that within each sector, business selection matters enormously. I am not buying sector ETFs or making broad sectoral bets. I am identifying specific businesses with competitive advantages, strong balance sheets, and excellent management. The sectoral tailwinds improve the odds, but individual company quality determines actual returns. In insurance, I am focused on companies with demonstrable underwriting discipline, companies that have maintained profitability during soft markets by walking away from unprofitable business, companies with conservative reserve practices, companies with management teams that own significant stock and think like owners. In energy infrastructure, I am focused on companies with irreplaceable assets in critical locations, pipelines that connect major supply basins to major demand centers, LNG terminals with long-term contracts, transmission lines serving regions with data center growth. Monopoly or near monopoly positions are ideal. In healthcare, I am focused on companies with durable competitive advantages, proprietary technology and medical devices, regulatory barriers that limit competition, scale advantages in healthcare services, strong brands in consumer healthcare products. The demographic tailwind helps everyone, but companies with competitive advantages will capture more of the opportunity. Let me close with some thoughts on what could go wrong, because no investment thesis is without risk, and understanding the risks is essential to managing position sizes appropriately. In insurance, the primary risk is that catastrophe losses are even worse than the industry is pricing for. Climate change could accelerate faster than expected. A major hurricane could devastate a major city. California could experience a wildfire season that exceeds anything in history. These events would hurt even disciplined insurers in the short term, but they would also accelerate the repricing cycle and ultimately benefit survivors. The risk is more about timing and volatility than permanent impairment. In energy infrastructure, the risks include regulatory intervention that limits returns faster than expected, renewable energy adoption that reduces gas demand, and general economic weakness that reduces electricity consumption. These are real risks, but they work against structural forces that are extremely powerful. AI isn't going away. Data centers aren't going away. The need for reliable electricity isn't going away. I believe the tailwinds overwhelm the risks, but I size positions to survive if I am wrong about timing. In healthcare, the risks include government price controls on drugs and devices, changes to Medicare reimbursement that compress margins, and competitive dynamics that erode positioning. Healthcare is also a sector where technological disruption is possible, though the pace of change is typically slower than in technology sectors. These risks argue for diversification within healthcare rather than concentration in a single company. Despite these risks, I am more confident in these three sectors than I've been in any sectoral thesis in years. The combination of structural tailwinds, reasonable valuations, and near-term catalysts is rare. Most sectors have one or two of these characteristics. These three sectors have all three. The next 2 years will demonstrate whether I am right. The insurance repricing will either continue or reverse. The AI electricity demand will either materialize or disappoint. The healthcare demographic wave will either drive demand as expected or be offset by other factors. the thesis will be tested. But I've learned over 9 decades that when the odds are in your favor, when the thesis is sound, when the valuations are reasonable, you make the bet. You don't need certainty. You need favorable probabilities and the courage to act on them. Insurance, energy infrastructure, healthcare, 3 sectors where the risk-reward is extraordinarily favorable. 3 sectors where I am actively deploying capital before 2020. 3 sectors where I expect to generate returns that significantly exceed what the broader market provides. But let me go deeper on each of these opportunities, because the details matter enormously when you are actually deploying capital. Understanding the nuances separates profitable investments from mediocre ones. In insurance, I want to elaborate on why this particular moment is so compelling. The property and casualty insurance industry operates in cycles. There are soft markets where competition is intense, premiums are low, and insurers make poor returns. Then there are hard markets where capacity leaves, premiums rise, and insurers make excellent returns. These cycles have repeated throughout the history of the insurance industry. What makes this hard market different is that it is being driven by structural factors, not just cyclical ones. In past hard markets, the catalyst was often a single catastrophic event like Hurricane Andrew in 1992 or the September 11th attacks. After these events, premiums would rise, capital would flow into the industry, and within a few years, competition would intensify and premiums would fall again. This time, the catalyst isn't a single event. It is a permanent change in the risk environment. Climate change isn't going away. The increase in catastrophe frequency and severity isn't going to reverse. The historical data that insurers relied on for pricing is permanently obsolete. This means the hard market could last much longer than previous cycles because the underlying risk has genuinely increased. I am seeing insurance companies that I've tracked for decades suddenly generating combined ratios in the low 80s. For those unfamiliar with insurance metrics, the combined ratio measures what percentage of premium revenue goes to paying claims and expenses. A combined ratio below 100 means the company is making an underwriting profit. A combined ratio in the low 80s means the company is keeping nearly 20 cents of every premium dollar as profit before investment income. These are extraordinary economics that we haven't seen in decades. And remember, insurance companies also generate investment income on their float. Float is the money that customers pay in premiums that insurers hold until they need to pay claims. This money can be invested in bonds, stocks, or other assets. With interest rates now at more normal levels after years of near zero rates, the investment income on float is substantial. Companies are earning 4 or 5% on their bond portfolios, which adds to the profitability from underwriting. The combination of strong underwriting profits and increased investment income is creating earnings growth that the market hasn't fully recognized. Insurance stocks have performed reasonably well, but they're still not pricing in the full extent of the earnings improvement as quarters of strong results accumulate, as investors recognize that this isn't just a one-time bounce, but a sustained improvement in economics. The stocks should continue to re-rate higher. I am also paying attention to the capital allocation decisions that insurance executives are making. The best insurance companies are using their excess capital to buy back stock at attractive prices. They're not chasing growth by writing policies at inadequate prices. They're not making stupid acquisitions to deploy capital. They're returning money to shareholders through buybacks and dividends. This discipline is exactly what I want to see from management teams. Let me now expand on the energy infrastructure opportunity, because I think it is the most misunderstood of the 3 sectors. Most investors still think about energy infrastructure through the lens of the 20-teens, when shale production was surging, pipelines were being overbuilt, and energy infrastructure was seen as a declining industry with excess capacity. That narrative was never quite accurate, but it is completely obsolete. Now, the demand picture has fundamentally changed. We're not just seeing increased demand from AI data centers, though that is the most dramatic driver. We're also seeing increased demand from reshoring of manufacturing, from electrification of transportation, from the general trend toward electrifying everything. The United States needs to add hundreds of gigawatts of new electricity generation capacity over the next 2 decades. That is more new capacity than we've added in the previous 50 years combined. And we need to add the transmission infrastructure to move that electricity from where it is generated to where it is consumed. This is a multi-trillion-dollar investment opportunity that will play out over decades. Natural gas is essential to this build-out. Renewable energy advocates sometimes argue that we can power the grid entirely with wind, solar, and batteries. Maybe that is true eventually, but for the next 20 years, we need natural gas to provide reliable baseload power. Gas turbines can ramp up quickly when the wind stops blowing or clouds cover solar panels. Gas provides the flexibility that keeps the grid stable as we add more intermittent renewable generation. This means gas pipelines, gas processing plants, and gas storage facilities will be needed for decades longer than the market expected just a few years ago. Companies that own this infrastructure are positioned for sustained growth, not decline. The investment characteristics of energy infrastructure are also attractive. Many of these companies pay substantial dividends, often yielding 5 to 8%. The dividends are typically well covered by cash flows and have long histories of being maintained or increased for income-oriented investors. This is a compelling combination of current yield and potential appreciation. The tax characteristics can also be favorable. Many energy infrastructure companies are organized as master limited partnerships or MLPs, which have tax advantages that can enhance after-tax returns. The tax treatment is complex, but for investors in taxable accounts, the benefits can be substantial. Now, let me expand on the healthcare opportunity because I think the market is dramatically underappreciating what is coming. The demographic wave I described isn't speculation or forecasting. The people have been born, they're aging at the rate of 1 year per year. The increase in healthcare consumption is mathematically certain. But beyond demographics, healthcare has several characteristics that make it attractive as a long-term investment sector. Healthcare spending is remarkably recession-resistant. During economic downturns, people cut back on discretionary spending like vacations and restaurant meals, but they don't stop taking their medications or skip necessary medical procedures. Healthcare demand is driven primarily by need, not economic conditions. Healthcare also benefits from continuous innovation. New drugs are developed that treat conditions that were previously untreatable. New medical devices improve surgical outcomes. New diagnostic technologies enable earlier detection of disease. This innovation creates growth opportunities even within stable patient populations. The pricing environment in healthcare is often misunderstood. Yes, there is political pressure on drug prices. Yes, Medicare reimbursement rates face scrutiny, but the reality is that healthcare prices have increased faster than inflation for decades and will likely continue to do so. An aging population will accept higher healthcare spending as a share of GDP because the alternative is worse health outcomes. The political constraints on healthcare pricing are real but not insurmountable. I am particularly interested in healthcare companies with exposure to chronic conditions that require ongoing treatment. Diabetes is an enormous market that is growing because of the obesity epidemic. Heart disease requires medications and interventions that patients need for life. Cancer treatment has become increasingly effective, turning what was once a death sentence into a chronic condition requiring ongoing care. These chronic conditions create recurring revenue streams that are highly predictable. Medical technology companies are another area of focus. The devices used in surgeries and procedures have become increasingly sophisticated. Robotic surgery systems, advanced imaging equipment, minimally invasive devices. These technologies improve patient outcomes while generating substantial profit margins for the companies that develop them. The competitive dynamics in medical technology are often favorable. Surgeons are trained on specific equipment and are reluctant to switch. Hospitals invest in systems that integrate with their existing infrastructure. Regulatory approval creates barriers that limit new competition. These factors create durable competitive advantages that protect profitability over time. Senior care services represent another compelling opportunity within healthcare. As I mentioned, the baby boomers are just beginning to hit the ages where assisted living and nursing care become necessary. The demand for senior housing will increase steadily for the next 2 decades. Meanwhile, supply is constrained by regulatory requirements, capital intensity, and operational complexity. The senior care stocks were devastated during COVID when mortality in nursing homes spiked and occupancy plummeted. Many of these stocks still trade well below their pre-pandemic levels despite fundamentals that have recovered substantially. Occupancy rates are rising, pricing power has improved. The demographic tailwind is as strong as ever. This looks like a classic case of prices that haven't yet reflected improved fundamentals. Home health care is another subsector with compelling dynamics. Caring for seniors in their homes is typically less expensive than institutional care and is often preferred by patients and families. Medicare and private insurers are increasingly encouraging home-based care to reduce costs. Companies that provide home health services are benefiting from both demographic growth and this shift toward home-based care models. Let me also discuss how these 3 sectors might perform in different economic scenarios. Because robust investment theses should work across multiple scenarios, not just in favorable conditions. In a recession scenario, all 3 sectors have defensive characteristics. Insurance premiums are relatively stable through economic cycles because people don't cancel their homeowners or auto insurance during recessions. Energy infrastructure revenues are often contracted with take-or-pay provisions that guarantee cash flows. Healthcare demand is driven by medical necessity, not discretionary spending. These sectors should outperform in a downturn. In an inflationary scenario, all 3 sectors have pricing power. Insurance premiums adjust to reflect replacement costs, which rise with inflation. Energy infrastructure companies often have inflation escalators built into their contracts. Healthcare prices have historically risen faster than general inflation. These sectors provide inflation protection that many other investments lack. In a growth scenario, all 3 sectors participate in economic expansion. Insurance grows with the economy as more assets are insured and coverage. Limits increase. Energy infrastructure benefits from increased electricity and gas consumption. Healthcare benefits from both demographic growth and the economic growth that funds healthcare spending. These sectors aren't left behind when the economy accelerates. The combination of defensive characteristics, inflation protection, and participation in growth creates an attractive risk-return profile. These aren't high-risk, high-reward bets on uncertain outcomes. These are investments in essential industries with structural tailwinds and reasonable valuations. I want to emphasize one more point about timing. I've said I am focusing on the period before 2027, and I want to explain why that time frame matters. In all 3 sectors, the next 2 years represent a period when the investment thesis will become obvious to everyone. The insurance repricing will be reflected in earnings. The AI electricity demand will be visible in utility filings and pipeline utilization. The healthcare demographic wave will show up in company revenues. When investment theses become obvious, prices adjust. Stocks that look reasonably valued today will look cheap in hindsight if the thesis plays out. The opportunity is to establish positions before the thesis becomes consensus and prices reflect the improved outlook. This doesn't mean these are short-term investments. I expect to hold positions in all 3 sectors for a decade or more. But the most favorable risk-reward exists in the next 2 years when there is still a gap between current prices and the prices that will prevail once the market fully recognizes these opportunities. I've spent 9 decades looking for situations where the odds favor patient investors, situations where structural forces create tailwinds that persist for years, situations where current prices don't fully reflect future realities, situations where disciplined investors can earn returns that significantly exceed market averages. These three sectors represent exactly those situations. Insurance, with its generational repricing opportunity, energy infrastructure with its AI-driven demand renaissance, healthcare with its mathematically certain demographic tailwind. Three sectors, three compelling opportunities, three areas where I am putting capital to work before the window closes. That is where I am putting money to work right now, not because I can predict the future with certainty, but because I can identify situations where the odds favor patient, disciplined investors, and after 93 years, that is the only edge that has ever really mattered.